Hello friends, hi. In this particular video, what I'm going to cover is a transaction which has undertaken recently for the Equitas holding, and it is currently the filed with SEBI for NOC. The way it goes for capital deduction is it requires a permission from NCLT. What I'm going to discuss is what is this capital deduction scheme about, and what are the income tax implication on this particular transaction. So let us now move, or let me take you to this particular aspects or the relevant aspects of the scheme and the implication, friends. So, friends, it is a capital reduction of Equitas Holding Limited as well as its subsidiary Equitas Small Finance Bank Limited. It is largely the capital reduction of ESFBL, which is Equitas Small Finance Bank Limited. It is a small finance bank as per the RBI directions. So, Equitas Holding Limited is a listed company, which is EHL. The existing structure as it stands today is there are the promoters as well as public shareholders of EHL, which has made investments in ESFBL, which is Equitas Small Finance Bank Limited, which is a subsidiary company of EHL. Now, what they want is that because this particular company, ESFBL, is a small finance bank, so there are certain conditions which are laid down by the RBI while giving them license for conducting this small finance bank business. One of the condition or the key condition for this is that once they reach the net worth of 500 crores, then they have to try to get the company listed within 3 years of reaching this net worth of 500 crores. At the time of applying for this license itself, ESFBL has reached these net worth criteria of 500 crores. Accordingly, the company is required to get listed by September 2019. Further, there is the requirement of EHL is that EHL has to maintain 40% of shares for the period of 5 years. So 40% of shareholding of ESFBL has to be by EHL for the period of 5 years minimum. So what is the company contemplating is that the ESFBL is not in requirement of any further cash for now. So let us envisage a situation by which we do a capital reduction of ESFBL, pursuant to which my holding in ESFBL will be considered as 40% holding, and the additional 60% which will be required, let us not bring the additional cash for that 60%, but let us distribute our reserves to the extent of 60% of ESFBL directly to the shareholders. So the shareholding pursuant to this will be 40% will be held by EHL and 60% will be held directly by the shareholders. Shareholders will not pay or not give any consideration for acquiring the 60% shares. My friend, there will be no cash payment given by shareholders of EHL for acquiring 60% shares in ESFBL. So this is a capital reduction because the company is going to ESFBL is going to reduce securities premium, reserves, and balance in profit and loss account to issue the equity shares to the shareholders of for 60% stake. And the rationale for them is that okay, if the directly shareholders are holding the shares of ESFBL, then there will be increased or greater amount of transparency in the system, as well as the company which wants to achieve this target of listing these shares will also be achieved pursuant to this. So my friends, please keep it noted that schemes that the general SEBI circular which applies to the scheme of arrangement applies to the merger, demerger, or amalgamation of the companies and the listing of the companies pursuant to amalgamation or merger or demerger. It does not apply pursuant to the capital reduction of the company. So that auto listing may not be possible through this route. That could only be have been possible if they would have done it by demerging one of the undertaking of EHL to SHBL, pursuant to which they could have gone for auto listing. However, in the scheme also they have specifically mentioned that ESFBL will apply or will make a necessary representation for the to the stock exchanges for getting themselves listed after this particular transaction. However, the first requirement of holding 40-60 ratio is achieved by this capital deduction scheme. Now, let us move to a main element. as to what is the income tax implication for this particular transaction. So, my friends, in the hands of shareholders or in the hand of SHL, EHL, please be noted that is there any sale? No. Is there any exchange? Because original shares are still held by them, so there is no exchange. Is there any extinguishment of any asset? Because the shares are still held by the same, there is no extinguishment of any asset. Or is there any relinquishment of any rights pursuant to any of the capital asset held by them? It is again not the case, because their right to participate in the board meeting, their right to participate in the net proceeds in the assets of the company are still intact. Hence, there is no transfer in case, and hence there shall be no capital gain tax levy in the hands of shareholders or in the hands of EHL. The second question which may arise is there any deemed dividend implication under section 2 subsection 22 clause A? So the deemed dividend to be effective, there has to be distribution by a company of such that there is to the extent of the accumulated profit, such that there is release of asset of the company. Is there any cash or any asset getting distributed by the company? No. So there is no release of the assets of the company, and hence there is no negative implications under deemed dividend under section 2 subsection 22 as well. But deemed dividend under section 2 subsection 22 clause D, so what does it require? It requires that there has to be distribution to its shareholders. The amount, the specific reference of no release of the assets of the company is not there under 2 subsection 22 clause D. However, there is a reference which says distribution to its shareholders. What I am making distribution is not to EHL, who is my shareholder, but to the shareholders of EHL, right? So one could argue that deemed dividend under section 222D shall not apply in this case as well. However, the alternative view can be that, okay, I am distributing it to the shareholders of shareholder, which means that I have first distributed it to shareholder, and which the shareholder have distributed, that is, I have first distributed it to EHL, which the EHL has distributed to its shareholders. So the second argument which would come to someone's mind is that there has to be deemed dividend under section 222D for 2 times. This is one of the things, but however, the argument for this is as well that had it been the case, had it been the intention of the legislator to keep it to tax it twice, of tender deeming fiction under section 222D could also have been as wider as 222E, which does not only cover giving loans to shareholders but also any other company in which this particular shareholders is interested. So that could have been the case had it been that this was the intention. But however, for now it appears that there is no adverse implication under section 222D, as it only covers distribution to its shareholders. Now, in the hands of shareholders, it is pertinent to note that whether section 56 to 10 shall apply or not. So for being taxed under section 56 to 10, you should receive shares in a company without consideration, or for consideration which is inadequate consideration exceeding rupees 50,000. So in this case, the shareholders will argue that the shares of ESFBL which they have received is for discharging the consideration. That is, after this there will be slump in the value of EHL, right? Because EHL was also supposed to receive reserves and surplus of ESFBL. However, since these reserves and surplus are directly distributed to the shareholders of EHL by way of shares, they are not entitled to receive these reserves and surplus. To that extent, the value of investments of EHL will go down, or the market value of investments of EHL will to the extent go down, which will directly result in the slump in the value of shares of EHL. Accordingly, the shareholders of EHL will argue that the consideration for the shares of ESFBL is discharged by them by a resultant slump in the value of the shares of EHL. This is one of the argument. The other argument is that there is one view which the market has taken, that section 56 to 10 shall not apply on issue of shares. Accordingly, the shareholders will say that they have received the shares pursuant to the issuance by a company, and in such case, section 56 to 10 shall not apply. However, there are says against this argument, and this is about to be judicially tested. So for this first ground, there can be certain degree of reliance. However, for the additional ground, there seems to be a less degree of reliance. The one more implication which arises from the Income Tax Act is that, see, after, let's say that the value of EHL was high in around was higher during this cutoff date for section 112A, but after this particular transaction there will be slump in the value of EHL. Accordingly, there will be a good amount of cost step up which the shareholders are going to receive with the on the subsequent disposal of the shares of EHL. So this is what I wanted to share about the capital reduction of Equitas Holding Limited. If you require any clarification or have any query, please feel free to contact me on my number. Thank you, friends. Have a great day. Thank you, friends.